Hello everyone, this is Miss Noble and today we are going to look at the accounting unit. What I would like you to do is to give you guys a broad overview as to what accounting is and just to help you to develop an understanding as to the importance of accounting in businesses. So let's go ahead and get started. So here are the things that you should be able to answer by the time we reach the end of this little mini lesson. Number one, what exactly is accounting? What are debits and credits? What are the four basic account types? And then in the second part of the video, you will be able to answer what exactly is an income statement and a balance sheet. So let's go ahead and get started. So accounting is used by just about everyone. Personally, you use accounting to kind of keep track of the money that you have coming in and going out of your hands on your everyday expenses. But then on the business side, you have businesses who use it to kind of keep their business going. Investors make decisions based on how well a business, by looking at a business's accounting records. And then you have creditors who look at the company's records to see how well the company is doing and whether or not a company will be able to pay back a loan that they may give to them. And then of course companies have to pay taxes just like individuals have to pay taxes. So the IRS looks at accounting records as well as customers. So if we had to define what accounting is, we could define accounting as to be a system of recording and summarizing financial transactions and analyzing, verifying, and reporting results. So what this means is we know that most businesses go into businesses, or most people or companies choose to open up a business because they want to make money. And in making money, they are selling something, whether it's a product or whether they're providing some type of service. Well, what accounting does, or the purpose of accounting in the business, is to keep track of what is going on in that business financially. So they record all of the financial transactions. In accounting, we take that information and it's summarized into a format that's easier to understand. Then that information is analyzed. Someone has to verify the accuracy of it, and then you have to report it. So if you think about a business such as Walmart and McDonald's, who serves millions and billions of customers every day, it's a lot of financial transactions going on. There are a lot of things that's happening. There are things that's being sold. The owners or the managers in the company has to make purchases. There's different things that has to be reported. And so accounting is the function of business that kind of reports all the information, or is responsible for tracking all of that information and putting it in a format that the business owners and customers and the government and everyone else who needs the information can understand exactly how well a business is doing financially. So that's accounting. It's just keeping track, or tracking, I guess is the better word, what's going on within a company on the financial side. So let's move on and look at some key terms that relate to accounting. So some of the terms that you should be familiar with when it comes to accounting are the four major account types, and that will include assets, liabilities, income/revenue, and then expenses. Owner's equity is not necessarily an account type, but we will talk about what owner's equity is a little bit later. But again, assets, liabilities, income, and expenses are the major account types. And then two other terms that are very important in accounting are debit and credit. Debit just simply refers to the left side of an account. Credit refers to the right side of an account. And later on, this will make a little bit more sense when we start getting into more details about accounting. Assets are going to be the things that you own, such as your home, your cash, your jewelry. For a business, that could also be the bank accounts or the cash that's in the bank accounts. It could be the buildings that a business owner owns. It could be any type of cars or any type of equipment that the business owns. These are all assets, things of value that are owned. Then you also have liabilities, because sometimes when you're trying to purchase assets or do things within the business, you might not necessarily have all the cash you need, or you may not want to use cash. You may want to use credit, or you may need to take a loan to get these things. So when that is the case, then you have liabilities. A liability is a debt, or it's an obligation. It's something that is owed that has to be repaid. So assets, things you own; liabilities, things that are owed that has to be repaid. If we drop down here to income and revenue, pretty much the same words. Income or revenue is a money that a business is receiving, money that's coming into the business, money that a business earns through selling a product or selling a service, providing something. And so that's income, money coming in. Expenses, on the other hand, is going to be something that a business has to pay on an ongoing basis. So let's just say, for instance, I'm going to walk away for a second. For a business might have a utilities expense. In order to keep the business running, they have to pay the electricity bill. Imagine for a restaurant, they would have to pay a water bill, phone expenses, food, anything that you have to pay over and over again each month is going to be an expense. Okay, so assets, liabilities, income, and expenses. These are the things that are constantly going to be impacted on an everyday basis in a company, regardless of the company type, whether it's a restaurant or a barber shop or a shoe shop, whatever it is, it's going to have assets, liabilities, income, and expenses. Now, the difference between what a business owns and what they owe to others is going to be the equity or the net worth. Okay, equity can also be defined as the owner's share in a business, the owner's right to the owner's part of a business. So imagine if there was an owner who decided to invest in the business and they invested $1,000. The $1,000 would be their initial investment. Anytime the business makes money, as part owner, the owner will be entitled to receive some of that income. And so that income is going to be their retained earnings. So the owner's share is going to be what they initially invested plus whatever they've earned since being an owner. And generally that is going to be calculated by looking at the value of the business, what the business owns less what the business owes. A lot of information, but for right now, I just need you to understand what an asset is, a liability is, what income is, what's an expense, and a debit and a credit. We'll come back over that, go over that again. Okay. The other thing that you should be familiar with is that there are two different types of financial statements. And in part 2 of this video, I'm going to go into details and explain to you more about the balance sheet and the income statement. But just know that a balance sheet is going to be a financial statement. It's a statement that shows what a company owns and what a company owes, and it shows the value of that company. So it's going to show all the things that the company owns. It's going to show all the things that the company owes, and then the difference between those things is going to be the equity. And in the end, you want to see that a balance sheet is going to balance. But again, we're not going to worry about that because that's in part 2. So let's go back to the essential questions, the things that I said that you should be able to answer in part 1 of this particular video. Number 1, what exactly is accounting? So accounting is going to be a system that's used by businesses to kind of keep track of what's going on in the business financially. This is where you're reporting every time something is sold. You're reporting anytime something is bought by the company. You're recording how much money the company made, how much money the company spent. It's an entire system of recording the financial activity of a company, taking that information, summarizing, verifying it is correct, and then essentially putting it in a format where someone can understand in the form of a report what is happening with that company. Debits, on the other hand, are going to be the left-hand side of an account. This information is explained more in video 2. And credit is going to be the right side of an account. The 4 basic account types are going to be assets, liabilities, expenses, and income/revenue. Once again, an asset is going to be something that you own, such as cash, such as a building, such as equipment. A liability is going to be something that has to be paid back, such as a loan that you took out for a building, or a credit card, the balance on a credit card that you have for your business. Income is going to be the money that you earn, and revenue is the money that you earn from selling your products and services. And then expenses is going to be those things that you have to pay on a daily basis, or the things that a company has to pay on a daily basis to keep the business operating. Accounting may seem a little complex, but again, all you're doing is just tracking what's coming in, what's going out, and showing what is happening on the financial side of a business. Hopefully all of this makes sense. Once you are finished watching video 1, then you should move on to video 2, which explains in more detail debits and credits and talks more about balance sheets and financial statements.